Give us your general view, if you don't mind, of what and how you're thinking about this surge in energy prices. And significantly, it didn't show up in a big way yesterday in the PPI, and it's modest today in the import price numbers.
Well, the important thing to look at as it relates to the energy prices is how high are energy prices going to stay and for how long are they going to stay there? As you know, energy prices are really important for individuals and for consumers. They feel the price of gasoline at the pump every time they go to refill their cars. And so it really can weigh on them. And so we have to look at both sides of that impact. On the one hand, it may be more inflationary and it may be keeping prices higher than we would otherwise want. But on the other, if it starts to impact consumers and their willingness to spend, that could mean that we see some impacts flow through in the growth numbers that could ultimately flow through into the employment numbers. We have two sides of our mandate that we have to balance, both the employment and the inflation side. And that's why I think that rates are in a good place. My baseline is that we're going to remain on hold for a good while. But I do think that there's two-sided risk to rates. I think there's risk that we might need to be more accommodative or more restrictive, depending on how the data comes out. But that's why it's a good time for us to stay patient and wait and see how the data flows through.
Do you have a bigger concern here when it comes to both sides of the mandate? Is your bigger concern on the inflation side, or is your bigger concern right now on the concern about economic weakness?
I'm concerned about both sides, but from my perspective, what I see is a labor market that's reasonably in balance. It's a curious balance. We're not creating a lot of new jobs, but given the supply side on the labor picture, it looks to me like we're roughly in balance. On the inflation side, we've been missing on our inflation target for 5 years. And what that means, I'm focused very much on what this means for everyday individuals. Since we've been missing on our inflation target, we've been above that 2% goal over the past 5 years. Individuals have experienced a decade's worth of inflation in that time period. Let me put that into practical terms. If you're going to the grocery store and you used to spend $100 to fill your cart, it now costs $120. If inflation had been at 2% over that period, it would be closer to 110. And that applies to groceries, that applies to haircuts, getting your car fixed, whatever it might be. And those are the things that I hear when I'm out in the district. Individuals who are really struggling to make ends meet. They've had to trade down over time. They've had to go from name brand to store brand. They've gone from buying steaks to ground beef to maybe now they're only able to afford beans and pasta. And so I have to look at both sides of the mandate. And to me, I think that we're right around where we want to be on the labor side, but we're still persistently missing on that inflation side.
President Hammack, the last minutes to the Fed meeting said that some believe that a rate hike could be appropriate if inflation were to remain above target levels. Were you among those people who believe a rate hike could be appropriate?
My baseline is that we're going to be on hold for some time, but I do think that there's risk that we might need to be either more accommodative or more restrictive in policy. I think it's just too early to say. We've had a series of these supply shocks over the past couple of years. We were on a good path at the end of 2024 when we first began reducing rates. Inflation had come from above 7 to below 3, and we had good line of sight to getting back to that 2% objective. Then, of course, we had the tariff shocks, and more recently, the conflict in Iran. All of these successive supply shocks are hard to think about how we're supposed to handle those from a monetary policy perspective. Normally, you like to look through these types of supply shocks, but when it's coming on the back of already elevated inflation, it may not be the same as it would be had we be entering this period at low and stable inflation.
A central theme of those who have suggested the Fed could and should cut interest rates now is their belief that the labor market will not be a source of inflation. How much confidence do you have that the labor market will not be the one where wages go up and push overall inflation higher?
I don't think right now that the labor market is a source of inflationary pressure. That's not what I'm hearing. I do hear that there are some risks and there are pockets, particularly out in the 4th district, the Cleveland district. What I hear particularly from manufacturers or from construction companies is that they have a hard time finding workers. It's hard to get people to come and show up, to be there repeatedly. What I'm focused on the inflation side is that we make sure that we're maintaining inflation expectations. We've talked a lot in the recent past about how the labor market, when unemployment increases, it can increase quite quickly. And so you want to get ahead of that. That's also true on inflation expectations. Right now, inflation expectations look to be reasonably well contained, but it's important that they stay that way. And that gives us time to be patient and to make sure that we can deliver on both sides of the mandate.